Good morning, everybody. Welcome, and thank you for joining us today for the third webinar in the NAS Investment Solutions webinar series. Today's topic is Self-Direct and Diversify IRA Funds into Real Estate. We know your time is very valuable, so the webinar will only last 30 minutes. There will be a presentation from industry expert and Vice President of NuView Trust Company, Jason DeBono, and then an interactive discussion between Jason and Karen E. Kennedy, President and founder of NAS Investment Solutions and National Asset Services. If you have any questions for the panelists, please submit them by using the Q&A feature through Zoom. And with that, I will hand it over to Jason. Jason, can you hear us?
All right, there we go. Can you guys hear me okay?
And thank you.
Hey, Roxanne. Hi, Karen. How are you guys doing? And hi to all the participants today. All right, well, I'm going to go ahead and share my screen. So we should, give me just 1 second here. Sorry, give me 1 second. It's not letting me... All right, so that should pop up for you guys there. Hopefully, can everybody see the slideshow? All right, I'm Roxanne and Karen. Can someone just confirm that we're okay as far as being live?
Yes, I can see it. Thank you,
Awesome.
Jason.
Sorry about that, guys. It took me just a second there, but so thank you so much for the introduction, and so glad to be here. My name is Jason DeBono, and I work with NuView Trust Company and as Vice President here for the last 15 years. So we're going to talk today about how to use retirement money to invest outside the stock market. And I don't know the individual background or makeup of each of the participants today, but I would imagine, like many, we're all trying to figure out how to navigate through the investment world. And now more than ever, I think there's it's pretty apparent the disconnect between the kind of economic world and the stock market. And if you look at what it's done and how it's performed in very incredible ways, which is great, it just seems very disconnected. And so self-direction is about taking your money and investing it outside of kind of Wall Street-backed investments and investing it into Main Street. And we're going to talk about that in the form of real estate today. As Roxanne mentioned, if you do have questions, certainly get those in. We are going to do some Q&A at the end as well, so we'll probably, we may take one of them here and there, but for the most part, we'll hold those all and discuss them at the end. Just so everybody understands, I as an individual, but NuView as a company, we are not investment advisors, CPAs, attorneys. Our job is to provide custody of retirement accounts, not to provide investment advice or endorse or approve investments. So everything we're talking about today is for educational purposes. How self-directed IRAs fit and impact in your financial plan is unique to each of you. And we can certainly talk and help you understand that process. But any of those individual legal or tax decisions should be made with the appropriate professionals. So one of the things that a lot of people tend to look at is they get investment specific. So they think about what do they invest money into, and that tends to be what kind of leads the process. And one of the things that we like to do is help and remind investors that it's really a two-part decision. So to kind of illustrate what I mean by that is your investment is not the only thing that matters. A mediocre investment in the right vehicle will outperform a great investment in the wrong vehicle. And I'll illustrate that in numbers for you today. So the first thing is tax. I think everybody on here probably understands the basics of our tax system, but at the end of each year, right, they total up what we made for the year in both earned income, right, that's our wage and job income, self-employment income if we have any of that, and then investment income. And we total all that together, and then we take all of our deductions, and then whatever's left in terms of income is taxable. And so that's how the tax system works. We pay that every April 15th, and this year, July 15th upcoming because of the COVID. So what people don't tend to realize is they think that if they made an investment and made $50,000, that they actually made $50,000. And the reality is that $50,000 generally is going to have some tax implications tied to it. And I'll illustrate kind of how that works. So if we take $1, right, and we double it 20 times. So assume that we double it every year for 20 years. So $1 becomes $2, $2 becomes $4, $4 becomes $8. And we do that in a taxable account, meaning our personal money, right? When we do that, we can turn $1 over a 20-year period into $72,000. So certainly most people would suggest that they're doing great things. And I think if you told me you turned $1 into $72,000 over a 20-year period, I'd think you're a fantastic investor. But the same dollar in the same investment, but simply done in a tax-advantaged account, which a self-directed IRA fully provides, eliminates that annual taxation. So if you kind of look at the chart there, $1 became $1.75, right? Because $1 doubled to $2, that's $1 of profit. We paid 25% tax on that dollar of profit. It cost us a quarter, and so now we have $1.75 to reinvest. Well, in a self-directed account, IRA account, you don't lose that 25% or whatever your tax rate is. So in this scenario, again, the same dollar doubling for the same time period, instead of having $72,000, is going to end up becoming just over $1 million. So when we talk about wealth building, a lot of times people think that people that build wealth do it because they make great investments. And I just want to make sure everyone understands that that's a piece of it. But the bigger piece is not making good investments, it's making good tax-efficient investments. So when we talk about IRAs, yes, they are a retirement planning tool, but what IRAs really are is a tax-advantage tool. And they're one of the few legally permissible, widely accepted plans. It's not unique, it's not some very convoluted tax scheme that some very smart attorney has drafted up for some very wealthy customer. This is average American available tax planning. And so if you sit here and you ask yourself, are my investments making me $1 million or are they making me $72,000? And if they're making you 72, before you consider it being the wrong investments, you may want to consider whether or not it's the right plan. Obviously, once you're inside that plan, then certainly the right investments are critical, right? And we're going to talk about that today in terms of how to use your retirement plan to get out to Main Street, to invest in stuff that you can know and understand. And we'll talk about that. But just remember, as we discuss this today, that when it comes to making money, it's a two-part process. One is figuring out how to maximize yield or return, right? The right investments. And then the second is, what vehicle should I put those assets into? And we'll talk about some strategies that people deploy. So when it comes to a self-directed account, the beauty is you can buy anything and everything that you desire so long as it's not life insurance or collectibles. So you could take your IRA today and you could move it from someone like a Charles Schwab who's going to put require that account be held in publicly traded securities. And you can move it to a non-traditional custodian like NuView Trust Company, and you can buy anything so long as it's not life insurance or collectibles. The second set of rules has nothing to do with the asset class, but they have everything to do with making sure that the tax advantage vehicle operates under an arm's length. They want to make sure that you're buying and selling investments from unrelated parties, right? They don't want you doing business with yourself, most of your family members, or businesses that you're tied to. And the idea behind this, and logic, if you will, is that if you were to take your retirement money that's tax beneficial to you, and you were able to go buy a property, let's just say from your dad, well, it would be really beneficial for your dad to sell it to your IRA at a significant discount, right? Giving your dad a tax loss, and then giving you this growth inside an IRA that's completely tax-free. So very few limitations. So as long as you're investing into passive investments, and certainly real estate's an easy thing to stay passive in, the sky is the limit in terms of what you're able to buy within your self-directed account. So certainly lots of opportunity there. So what does a self-directed account buy? Well, the first answer to that is anything and everything. But we really boil it down, and while I think there's 6 or 8 items in this kind of diagram here to give perspective, it really boils down into 3 primary categories. The first one is real estate, and this is real estate of all types. We see everything from single family to multifamily, raw land. We see, easement property with billboards on it. We have clients that own burial plots. We have clients that own docks that are all deeded. We've got clients that own citrus farms and groves, and you name it. As long as it's passive to you, your IRA can own it if it's deeded real estate. The second area that we see, second kind of the 3 asset classes we see are mortgages and notes. So private lending. So this ranges from secured in the form of mortgages to unsecured. We see debt in the form of business debt, so people loaning money to businesses. We see personal loans, frequently. And so there's a variety of debt instruments that exist out there, and that's certainly something that we see. The third category, which makes up kind of the big 3, would be private placement / syndications. So, as we talk a little bit today about real estate, we're talking kind of real estate in a syndication model. So something that is packaged up where multiple investors are investing into the same product. So, when I mentioned real estate, we talked about a one-off house or a rental condo or something along those lines. In the private placement / syndication world, these are, again, kind of they're syndications of asset or a series of assets out to a group of investors. So it could be a $4 million office building, or it could be 4 $4 million office buildings, apartment complexes, self-storage, a variety of these investments. So they tend to be real estate related. Not all of them are. You can invest into private companies of any sort, but we see a significant amount of activity in that area, and something that we're going to spend some time talking about today. So as we look through this and we talk a little bit about kind of passive investments, we talked a little bit about real estate, and we mentioned kind of some of the things that we see our clients do. The thing about real estate is if you buy a passive real estate investment directly, so a single family home, a rental condo, a piece of raw land, those activities, while they're passive in nature, require much more activity. So, for example, if you're going to buy a piece of real estate and rent it out, you obviously either have to hire someone to manage that, or you have to manage that. There's expenses that need to be paid, and someone has to take responsibility of that and direct the IRA to make those payments. There's tenants that have to be vetted and screened. There's toilets that need to be repaired. And so for real estate, a lot of investors, that love real estate may not take that route because it can be a lot more work and effort. So a lot of clients look at things like syndications, and we talked a little bit about them, but let's talk about their place in an IRA. Syndications match up and marry up to retirement accounts very well. Syndications tend to be long-term, so you typically don't invest into a syndicated real estate deal for 6 months, whereas you very well could buy a piece of property and liquidate it after 6 months. So syndications fit nicely into an IRA, which is already earmarked for the long term. The other thing that's nice about syndications is, as a general rule, they're completely passive. So the investment sponsor, investment manager, the group that's managing the syndication, they're the ones that are taking responsibility to ensure that there's property management in place, managing the expenses, the income, the overall, improvements to the property, as needed. So the role of an investor into a syndication is very passive. So much like when we buy stocks and bonds in an IRA, we can tend to buy them and hold them for the long term. Syndications fit very nicely for that purpose. Syndications are also nice because it allows you to enter into the real estate space without having to be a real estate expert. So, again, I mentioned at the very beginning, for many investors, it's really hard to navigate through the stock market. And, I've been doing this 15 years. I've been on lots of spoken at lots of investment conferences and been referred to often as a subject matter expert. Yet I sold Apple, Amazon, and Netflix in the middle of March, right? Which if you want to know how good of an investor I am from a stock standpoint, I would be terrible, right? All 3 have since gone on to achieve record highs. And, I sold them because I just don't understand it. I don't know what makes them go up and what makes them go down. But I can look at real estate, whether I own it directly or whether I choose to own it through a syndication, and I can get basic knowledge and understanding of how it works. I understand that rent comes in and expenses have to be paid, and if there's more rent than expenses, right, in theory, I'm making money. I also understand that I can make money if the property value itself goes up, and sometimes driving the rent up actually increases property value in certain properties. So when I look at real estate, I can understand it fundamentally. But if I don't want to go out and find my own investments, I can turn to syndications as a way to invest into real estate, product I can see, touch, and feel, know and understand, right? Certainly a lot more than stocks and bonds, but I have that professional management of that asset. And so I can look at the track record and performance of the individuals that are overseeing it, and I can leverage their knowledge and their experience. Whereas in the financial world, I can leverage lots of advisors' experience, but it's a little bit of a guessing game for everybody. Debt. So we talked a little bit about this. You can invest into debt actively or passively as well. So if you're interested in investing into a passive loan of any kind, you can do so, or you can go out and find people that need to borrow money. You can be as active or as passive as you'd like in that. Crowdfunding. This is something that we're seeing a lot more as the Jobs Act kind of started to open this up. But crowdfunding is a way under some regulation exemptions for individuals, much like syndications, to offer through more of a publicly available means some private investments. So as we talk to all clients in the crowdfunding world, make sure that you're very aware of the sponsor and the track record, because very little barrier to entry like there are in syndications. So make sure you're doing your due diligence. And then lastly, private equity and investment funds. So there's private businesses that go on all day, every day. And so as we look at companies like Uber, Uber was a private company before it went public, in the last year or so. Prior to being public, if you had access to it, you could invest into it. And there's investments right in your backyard or people you may know that are private by nature. So that's certainly an opportunity as well. So that is all that I have. Obviously, in 15 minutes, we're not going to cover everything. I think just to summarize, as we kind of get ourselves prepared to take some Q&A and open some dialogue with Karen, the key is your IRA is not forced into the stock market, right? There are custodians out there like NuView that will let you invest beyond traditional Wall Street-based investments. And real estate, coupled with the tax benefits of an IRA, can be a very good strategy to both make sure you're in the right plan, in the right investment that you know and understand, that can help you gain and build wealth towards retirement. So with that said, I'll kind of open up the dialogue. I think Karen's going to join us here.
Here I am.
Hey, Karen.
Thank you, Jason. And welcome, everybody, to the third of a series of webinars intended to provide you with some educational foundational pieces as you develop your own portfolios. So I've received a number of questions before and a few during the webinar. And let's see if I can read without my glasses. So when I'm looking down, that's what I'm doing here. So how do 1031s, Jason, work within a self-managed IRA or Roth?
Yeah, so what a really good question, because 1031s are near and dear to my heart. I love tax-advantaged investing. So 1031s and IRAs are completely different but serve the same purpose. There is really no point of intersection between the two except for in very, very complex scenarios. If you think about what an IRA does, an IRA is built-in tax deferral. So in an IRA, there is no annual taxation, and that goes back to that slide of doubling a dollar. So
Right.
If I make $1,000, I keep 1,000. I make $1 million, I keep $1 million, and I can reinvest that year over year without taxation, and that's per the rules of IRAs. What a 1031 exchange does is it allows you to take assets that you've already bought personally, right, specifically real estate, and it allows you at the point of sale to make a declaration via 1031 exchange to move it into a like-kind property and maintain the tax benefits or tax advantage growth. So the big difference between an IRA and a 1031 is in an IRA, it's built in. In a 1031, it's only declared and only valid if you declare it before you sell it, and then you have a certain amount of time after sale to find a replacement property to maintain that tax advantage. And in an IRA, you don't have any declaration, nor do you have any time after sale, and nor do you have to buy a like-kind property, which is really cool. So I'm not saying the IRA is better, but it's different. True long-term.
Right, because in a 1031 with real estate, you must buy like-kind.
Yeah, and that can, for some investors, can trip them up a little bit, and you have to buy in a defined time window. So it's a great program. If you own real estate and are selling it and don't need the cash today, I would strongly encourage everyone to do a 1031 exchange if you're interested in a like-kind investment. Right,
because the only thing that gets you out of paying taxes is death. That's it. Otherwise,
that's
you got to pay the piper.
Yeah.
Okay, on to more palatable, happy things. Let's see. Oh, can you walk us through the mechanics of moving money from a Fidelity? Because I moved money from a Fidelity account myself into into a different custodial process, and I found that Fidelity, they were easier than I'm told that some of my friends have had, but they don't want to give up the business, so it took them forever to do what I thought should just be slam dunk. And then there's these appraisal requirements, et cetera, during the holding period in reporting back. So if you could walk us through what that looks like and set reasonable expectations on timing, what they should be, that would be helpful.
Sure. So, you alluded to a couple of things, and I'll kind of take them chronologically in terms of process. And I'll start by saying this is a self-directed account. It's self-managed. And so when you take that on, you are taking on some responsibilities, and we'll talk about what those are. Thankfully, today, the world has gotten a lot better at moving money, and it's become a little bit faster and easier. I started 15 years ago, and I assure you it was like pulling teeth. It was bad. And so we don't run into that as often as possible, but it can be a process. Typically, the way it works is relatively simple. You'll establish an account at the new custodian. So if it's NuView, you would go through NuView and establish your account. If it's an IRA, then NuView will go get the money on your behalf. So we will go directly to Fidelity, Schwab, Merrill Lynch, whomever's holding it. And with your authorization, we will request either part or all of the money that you want transferred. Typical time frame on that we let people know is anywhere from 5 to 7 business days. It can be longer if you have an advisor that's in the way and is trying to slow the process down. It can be longer if you're invested into securities and you don't have any cash available because they have to be liquidated. And if they have if you have a $100,000 portfolio and you only want to transfer $50,000, Fidelity will not call you to ask you what $50,000. They'll just mail a letter back to us that says, sorry, there's no cash to do this transfer. So there's some things that can slow the process down, and our new accounts team tries to work and understand kind of what people are doing and at least get out in front proactively of anything that we can.
That's right, because like a Fidelity account or Schwab or whomever, they have it invested typically in stocks and bonds, and they have to liquidate that and place their orders in order to get the money in order to send and meet the obligation of the direction of the IRA holder.
Yeah, so we always recommend if you're doing a partial transfer, make sure you have that already in cash. It just speeds the process up. And then if the money is coming from an old 401k or 403b, 457, some kind of employer plan, then we cannot request it on your behalf. It's the employee's responsibility to initiate it. It's simple. You'll have to reach out to whomever's holding the money and request a direct rollover. They'll ask you for some information. You'll provide it. Those are a little bit of a longer gap. We see those sometimes as quick as a couple of days and as long as a couple of weeks. But 401ks are requested by the individual, whereas IRAs are requested by the custodian. Once it's in the account, it's up to you to tell us what you want to buy. You're going to identify your investment, do your own due diligence. When you let us know what you want to buy, we'll let you know what documents from that investment we need, along with what authorization forms on our end. And then lastly, annually, we will request a valuation. Now, typically the valuation, if it's depending on what type of asset you own, is going to depend on where you get your valuation from. If you're investing into something that's syndicated, In most cases, the syndicator will provide some kind of, general market value. We do not require that it be a full appraisal unless there's some sort of tax liability associated with it. Broker price opinion letters will work, but general directional market value requests is what we look for annually.
And how do you handle the RMDs?
So RMDs are required when you reach age 72, some before the age was 70 and a half. So some, depending on your age, may have been grandfathered in under the 70 and a half. But once you have to start taking money out of your account after age 72, there's a percentage that's defined based on your age. It has nothing to do with the custodian. But if you do not have, if your RMD for the year is $8,000 and you don't have $8,000 in cash in an IRA with NuView, then you're going to need to look elsewhere. So if you don't have cash in any other IRA, then it can be a little bit more difficult because you got to liquidate something. So most of our clients at RMD age keep a significant amount of money in cash. So they may have 20, 30% either in cash or in liquid securities. And then the money that's in real estate, they'll put with us. So a lot of our clients take their RMDs out of their brokerage accounts, their IRAs that's in brokerage, and leave their longer term illiquid assets untouched with us.
Oh, that's a good way to handle it. Okay. Let's see. Well, you talked about what your view is on the advantages of buying real estate with an IRA and the benefit accruing going forward and the various hold periods. So I think that answered that question. Let's see. So one person wrote in and said they're interested in tying up funds for extended periods of time and losing liquidity in real estate investments. We talked about that. That's really not an IRA issue. Once you decide you're more comfortable in real estate, as you used yourself as the example of how to lose money in the stock market. But I would say that for people who are considering this, if you're going, real estate investment is an illiquid investment. It is illiquid by definition. You're buying property. It's not going to move the needle every day that you're going to feel unless the needle hits the bottom and you don't have the money to pay bills or something. I mean, that's a whole other discussion, but it should be considered an illiquid longer term investment, and you need to be very mindful of that as you're putting your money in. You worked hard to get your money. Your IRAs are typically 401ks, etc., and you need to be mindful of making that money now work hard for you, as you did to earn it, and to be careful about it and where you put it. So for some people, depending on how they manage their money, tying it up is a positive thing because they can't get to it to spend it inadvertently, giving the benefit of the doubt. And for others, they want to have control over it and they want to manage it more tightly. So that would make a difference on if they're comfortable in real estate, whether they're buying a single family or whatever their investment is, so that they can manage it more closely as opposed to handing it to a sponsor to handle. If you're not comfortable with the sponsor, do not do the deal. Listen to your gut. But you need to evaluate what your own comfort zone is in terms of where you should be investing and the type of investments that you're willing to make. And then let the chips fall as they may. That's the way life is, right? It comes and it goes. So on that high note, Jason, did I forget anything? Is there anything you want to add? Because Roxanne's pinging us saying we're 30 minutes. We're 30 minutes.
Well, I'll just wrap up as kind of to piggyback on what you said with, illiquid investments aren't bad investments, but they're different investments. And so liquidity has its price, as I shared, right? The best thing for me would have been for those stocks to be illiquid, right? and I could have ridden the wave out. And I think for most investors, illiquidity is actually a good way to go, so long as it's in the right hands and to the right asset classes. So if you have liquidity questions, obviously, first it starts with asset class. Is that the right asset class for you? And then second, is there a vehicle that makes the illiquidity more palatable? And if I put my personal money into a deal that's got a 5 or 7 year shelf life, I don't know what kind of needs I may have. I have 2 kids. I could have expenses that money could be used for. But if I put my IRA into that deal, as a general rule, I'm not touching that money for many years. And so the 5 to 7 years of illiquidity doesn't cause me any harm or concern at all. So again, not bad. It's just different. But to Karen's point, something that, you've got to really give some thought and understanding to. So with that, I'll thank everybody for their time today. And Roxanne and Karen, thank you for having me.
Thank you. Okay, Roxanne.
Thank you, Karen. Thank you, Jason. And thank you to the attendees who submitted the questions. Recording of this webinar will be available on our website within the next 24 hours at nasinvestmentsolutions.com. And you'll receive a brief survey via email after this webinar, and we hope you take a minute to let us know your thoughts. Thank you, everyone.